Hello and welcome to the HFA webinar. This is Mitch Ackles. We are going to get started in about 5 minutes. We're allowing some of the attendees to get logged in, so please stand by. Hello, this is Mitch Ackles again, the president of the Hedge Fund Association. I want to welcome you to the HFA webinar 2020 Asia Pacific Regulatory Update. I'd like to start off the program by thanking our sponsor for the event, ComplianceAsia. They have been phenomenal members of the HFA, leaders of the HFA, and sponsors of multiple events. We will be sharing with you contact information for the ComplianceAsia team after the webinar, but I very much want to give them a shout out and thank them. And I want to give you a quick overview before we get started with the program of the Hedge Fund Association. So the Hedge Fund Association is a global nonprofit, volunteer-driven organization founded in 1996. Our members include the entire ecosystem of alternative investment firms, from hedge funds to private equity, venture capital, and real estate, to all types of allocators and industry service providers. We organize frequent events around the world, as well as webinars. And our regional chapters around the world, including in Asia, organize events, and once we get back to in-person events, we look forward to inviting you to them. You can learn more about HFA at hedgefundassoc.org. Now I would like to introduce our speakers today. Philippa Allen will moderate the event and provide some insights, and she is the CEO of ComplianceAsia. Alex Duperouzel, and I know I probably butchered Alex's name, he's the Managing Director for ComplianceAsia, and he is on our panel. Ji Yin is a partner with Han Kun Law Offices, and Koji Yamamoto is a partner with Withers Law Offices Japan, and Lisa Simmons is a partner with Ashurst. And now, without further ado, I'm going to turn over the moderator function to Philippa Allen. So, why don't you take it away?
Great, thank you very much for the introduction, Mitch. It's very nice to be speaking to everybody. Just as a matter of housekeeping, there is a question section, so you can type any questions into that, and we will try and answer them. And we also will provide via the HFA, all the slides to you later on, so you will get the content as well. We're going to cover a few different jurisdictions tonight and give you an idea of some of the current developments in each of Hong Kong, China, Singapore, Japan, and Australia, as well as just an update on sort of the licensing and access regimes in each of those countries, where there has been a lot of exciting things happening over the course of this year. So I'm going to hand over to Alex first, who's going to speak through a few issues to do with the current state of regulation in Hong Kong. Alex.
Well, good morning or good evening, wherever you happen to be. Very nice to be here today. I'm going to cover Hong Kong. And so if we could move to the next slide, please. Just waiting. Yeah, there we are. Offshore marketing into Hong Kong. So when you're in the alternative assets industry, there are two key things to consider. First of all, are you marketing a product or are you marketing a service? And in Hong Kong, there are two different rules depending upon what you're doing. So product-wise, the issue is whether or not you have a place of business in Hong Kong. The way the regulatory regime works, there are two sides to it. First of all, you need to conduct a regulated activity. That list is quite widely worded, but you must do so as a business. And so if selling a product into Hong Kong, essentially you'll need some form of business structure there. You'll need a company, you'll need some employees. It's relatively difficult to trigger the business requirement if you're moving on a fly-in, fly-out basis. There is no prescribed number of visits you could do to Hong Kong and not trigger the rules, because, as I say, it is about whether a court would see you as conducting a business there. But broadly, most of the major law firms will tell you that more than 5 visits will probably get you in trouble, and up to 5 won't. So it's a challenging little area, but at least it does allow some people to fly in, fly out, as long as you don't have any formal presence in Hong Kong. If you do have a formal presence in Hong Kong because you have a related party, maybe a part of your group that has an office there, then you do need to be very careful what you're doing on shore. And there is a mechanism for an offshore person to come to Hong Kong and to conduct regulated activities on a very limited basis. There is a thing called a provisional license that can be obtained in relation to short visits for that sort of thing. We've done it many times, and it's typically sought out by persons who have a marketing visit there. So no presence in Hong Kong. You can fly in, fly out, just don't do it too often. And obviously COVID makes that pretty difficult anyway. And if you do have a presence there, think about a form of temporary licensing. Marketing a service is quite different. It is a criminal offence to market any service into Hong Kong, which would, if conducted in Hong Kong, constitute a regulated activity. You'll notice I didn't talk about the business aspect there, when marketing into Hong Kong, it's simply a matter of whether you trigger the regulated activity side when marketing a service. So the SFC has published on its website a somewhat brief series of things which it would consider in relation to marketing a service. I can tell you from practical experience that this memo is well and truly out of date, and actually the SFC is a lot stricter than this. So take it with a grain of salt when you read it. There are 5 bullet points which we've put on this particular slide: detailed marketing plan, whether services are extensively advertised, whether related marketing is conducted in a concerted manner, etc., etc. I can tell you from a practical perspective that if you are contacting Hong Kong people and marketing a service to them, an asset management service, a broking service, the SFC will get very upset with you and more than likely contact your regulators overseas and ask you to desist. Could we move to the next slide, please? Offshore marketing into Hong Kong, the normal marketing practice is that there is some form of reverse inquiry or solicitation, and that means in relation to a product that if someone contacts you and they're in Hong Kong and they would like you to pitch for something, that's fine. It is only an issue in relation to services if you pitch into Hong Kong. So reverse solicitations, RFPs, are generally considered not to be in breach of the law. And as I've said earlier, a foreign firm may come to Hong Kong on a periodic basis, and while there's no specific number, typically up to 5 is fine. Next slide, please. There have been a small number of enforcement cases in relation to people marketing products and services. On the product side, there's a series of tax cases which you need to look at, which determine whether a business is being conducted or not. So you won't find them in relation to searching for securities cases. But in relation to services, there are a couple of cases, and we've mentioned them here. There's a case called Handtech. Handtech was a case where someone was trying to use Macau in order to run a foreign exchange business and was opening accounts for Hong Kong customers. It's fair to say the SFC in Hong Kong doesn't like people who set up in Macau and contact people in Hong Kong, and they're actively looking for opportunities to prosecute in that respect. Then there is another case where the court held that proactively advertising in Hong Kong was a breach of the rules, regardless of whether there was any sale of any product. It is actually an offence not only to conduct the regulated activity, but to hold out that you can conduct the regulated activity in Hong Kong. And the only notable case involving a US firm related to E-Trade. And I must say here, E-Trade had plastered advertisements all over the equivalent of the Hong Kong subway, and after doing that for some time were finally reprimanded by the Securities and Futures Commission and told to take them down. It would seem that the SFC hasn't really been that active in this particular area. So while it remains an offence, and while I could never tell you to do it, it would be fair to say that there hasn't been an enormous amount of prosecution in this area. We see a lot of nasty letters from the SFC. We see a lot of difficulties when firms are applying for licensing because there are all sorts of awkward questions asked if the firm has had a presence in Hong Kong before and hasn't bothered to get licensed. But essentially, there hasn't been an enormous amount of public reprimands or prosecutions in this area. Next, I'd like to move to licensing. And so we've talked a little bit about some of the requirements. When you are licensed in Hong Kong, you license as a corporate. There's no such thing as individual licensing per se. Individuals are attached to a corporate, and there are a variety of license types. if we can move to the next slide, please. There are 10 license types in Hong Kong, but the most common ones for alternative asset managers are either types 1, 4, or 9. I'm actually going to start in reverse. 9 is the most common. That is the asset management regulated activity, RA9, and that allows you to manage a portfolio of securities or futures contracts and to make discretionary decisions in relation to that portfolio. RA4 and RA1 are slightly different, and it's best probably described as RA9 relates to those people who make discretionary decisions, and RA1 and RA4 are where in fact somebody else is making the discretionary decision, and the activity involves either giving advice to someone, I think you should buy or sell, and then executing a transaction, I think you should go ahead and buy or sell this product. It should be remembered that the definition of securities is incredibly wide in Hong Kong. It includes not only publicly traded securities, but in fact private securities as well, the only exemption being a Hong Kong privately listed company. So if you are a venture capital firm and you are negotiating a term sheet in relation to a BVI company, and you're sitting in Hong Kong while doing so, you are probably dealing in securities under the definition of regulated activity 1. Next slide, please. There are some exemptions. Well, one slide back, please. Yes, thank you. There are some exemptions for licensing in Hong Kong. There's an enormous amount of misconceptions around licenses. People often say to me, oh, well, I'm only dealing with professional investors, so I don't need a license. That's wrong, you do. The only two exemptions which really exist here, first of all, there is a group company exemption. If you are doing pure research, i.e. you are just preparing advice for your parent company and your parent company is making all the decisions and you're not signing term sheets, you're not negotiating them in Hong Kong, then actually you probably don't need a license under the group company exemption. There's also an incidental exemption which applies to some license types, meaning that if you are making discretionary asset management decisions under type 9 and then you want to actually put a trade on the market, you don't have to go and get a separate type 1 license. We describe that more in these slides. Next slide, please. When considering a Hong Kong regulated firm, there are a couple of key concepts to get your head around. The first is, of course, as I mentioned before, it is the corporation that gets licensed. Then there are individuals attached to that corporation, and they break out into two broad categories. There are responsible officers and there are licensed representatives. The responsible officers is what it says on the pack. They are responsible for the conduct of the regulated activity. If something goes wrong in the corporation, they may be held responsible or may be held vicariously liable for the activities of somebody else in doing so. There are some criminal sanctions involved with being a responsible officer if something goes wrong, but the most common sanction against a responsible officer is where one of the staff has done something wrong, the responsible officer is found to fail to supervise, and then they may be fined or suspended in terms of their license. There are a variety of qualifications they need to have. Some are educational, some are in relation to character and financial status, and there are regulatory experience elements. It's a very, very complex area, and one I'd probably need a full hour to go through if we had to. Suffice to say, you need to find some responsible officers if you're going to have a regulated business in Hong Kong, and some of them will need to be onshore. Next slide, please. Now, when getting a license, we've set out there a series of things which you have to do. You have to describe to the Securities and Futures Commission what your business will be. You have to talk about who controls it. You have to describe how it will be managed, and there's a variety of different people that need to be named. There's also a strange little concept called managers in charge, which is a little bit like the SOX system in the United States. And you also need to talk about your financial strength and internal controls. Next slide, please. There are the manager in charge core functions. I won't go through those. Next slide, please. Every person who's licensed with the SFC, every corporation has a whole series of things they need to comply with. We have put a list of them there. There's a lot. I normally say to people it's about a foot of documents. Next slide, please. There are a whole series of ongoing obligations once licensed. There are all sorts of things which are time-based, and there are all sorts of things which are activity-driven that you need to comply with. A very long list of things. Next slide, please. There are AML obligations. They're not as stringent as they are in Singapore because there's no real look-through back into investors, but essentially the SFC does expect people to have thorough anti-money laundering, countering the finance of terror controls. There is a suspicious transaction reporting regime, and there's a requirement to appoint a money laundering reporting officer. The body to whom STRs are filed is called the JFIU in Hong Kong. Next page, please. Now, some recent discussion in the press about the national security law in Hong Kong. The national security law is a very, very difficult piece of legislation that has been brought in by the mainland authorities, and that makes it a criminal offence to do a whole series of things relating to the territorial integrity or, in fact, the ongoing security of the People's Republic of China. The offences there are offences which would trigger the threshold for reporting under the suspicious transaction reporting requirements. And so essentially, if I was to do something which would breach that law and there was money involved in it, let's say I was paying someone to do something which breached that law, then a bank would be required to file a suspicious transaction report about me. There's nothing really that unusual about the national security law in terms of its relationship with money laundering, and we haven't yet seen any major prosecutions proceeded with. We've seen one very large, high-profile arrest and some charges laid, but we're yet to see how the courts will handle those. So everyone will be watching those, and you'll see a lot of that in the media. But essentially, from my perspective, as someone who's dealt with AML for a long time, I don't really consider that particular law any different from any of the other laws relating to complex financial transactions. The US is obviously making a lot of statements in relation to Hong Kong at the moment, and Hong Kong does seem to be caught up in quite a high-level dispute between the two countries. Next slide, please. One last thing before I sign off, EDSP. This is all about electronic data. As the world has evolved to holding more and more of data in the cloud, unfortunately, the Securities and Futures Commission has just sort of woken up to that, and in a very sort of late 90s approach to this, has come up with a series of very hard and fast rules of how this electronic data is to be stored and distributed. There will be some announcements soon about this. They're not particularly friendly announcements. I think the way to get through this is wherever you can have data backed up into a local drive, please do so. but you should expect, if you have an office in Hong Kong, some fairly ugly pronouncements coming up for people that hold lots of data in the cloud. Next slide, please. Great, I think that gets my part of it done. Thank you very much, and apologies for going a couple of minutes over time.
Thank you very much, Alex. I'm going to apologise slightly in advance. I seem to be having some audio problems, so if I do drop out, please, Mitch or someone, if you could just let me know on the chat, that would be great. So before I launch into Singapore, I just thought I'd spend a couple of minutes on some of the developments around fund structures in Asia at the moment. We've seen a bit of a flurry of fund structures. So we have our first one that was launched, was the oldest, if you like, that was launched, but has been finalized this year, which is an open-ended fund structure in Hong Kong. It's been toned down from the original structure. It's basically the first corporate fund structure in Hong Kong. If we can go to the next slide, please. And it is proving relatively popular. Next. Thank you. It's essentially, like all the other funds, is intended to concentrate everything into one Asian jurisdiction. There are some tax exemptions, but they're not ideal, so it's certainly not as good a structure as some of the work in Singapore that's being done. And however, the most attractive part of it probably is the mutual recognition scheme with the mainland, where they'll be eligible to be sold into China directly. Weirdly, there's an arrangement with Switzerland as well, but I don't think that's of much relevance. Next, please. Against the OFC problems, there's definitely some concerns at the moment about the onshore laws. They also have introduced an LP structure. This is a new structure. It's actually a very good structure in Hong Kong. And there is some interest from alternative managers at the moment. This is being particularly driven by the issues with Cayman having been on and off the blacklist. Again, I'm not going to go through it in too much detail. Suffice to say that there are no investment restrictions attached to it, so it is quite suitable for an alternative structure if anybody did want to domicile in Hong Kong. The next slide, please. If we can just, sorry, Mitch, if we can move on to the Singapore ones. I think the big bear, if you like, in the corner is the variable capital company in Singapore. So the next slide. It is part of Singapore's overall drive to establish itself as the Asian hub for fund management. And they've put together an entire eco-structure around fund management with a simple way of setting up as a fund management company, onshore fund administrators. Sorry, if we just go back a little bit. Onshore fund administrators, and they've topped it up with this. Sorry, Mitch, we've gone a little bit too far forward. If we could just go back a couple, I'm still talking about the VCC in Singapore. So perhaps if we just pause it there for a second, I'll speak to the point. And so the VCC is a simple corporate structure. It can be launched in a pretty fast period of time. It requires an onshore manager, onshore directors, and onshore fund administrators. It's got some excellent tax exemptions. The government is subsidising the establishment of them by paying for the legal fees and tax advisor and compliance fees, which is proving attractive. There's now 155 very
I think we're losing you, Philippa.
Philippa, we can't hear you.
Sorry, there's many different names in Singapore, variable capital companies that have been established. Yeah, thank you, Mitch. I will see what I can do. Okay, is that any better?
Yes.
Great. I hope you can hear me now. Super. So just moving on to Singapore. In the pack that we'll send people, there's quite a lot of details about those fund structures, but I won't talk to them now. So in Singapore, there are numerous different categories of fund manager license. The Singaporean government is very keen to ensure that there's a category for everybody. So there's a sort of startup category, the registered fund managers, where the AUM is less than 250 million Sing. You have two types of licensed fund managers who deal only with accredited or institutional investors, and retail fund managers. And you also have a venture capital fund management regime. Each of them has broadly the same requirements. So if we go to the next slide, this talks about the structures you need to have in place with the years of experience. But broadly, you can set up as an alternative manager in Singapore with two people onshore. There are some tax exemptions in Singapore. They only kick in when you've employed a certain number of Singaporean investment professionals, but they are quite advantageous, and you end up with a very low tax rate for your management company, which has been attractive to people redomiciling out of the Cayman. You are still paying tax, but it's lower than you would do normally. It's meant that places like Japan have been agreeable to finding Singapore to be a low tax but not a no tax jurisdiction. Next slide, please. The question of marketing is relatively clear in Singapore. There's an excellent mechanism for registration of funds, and you can register either as a full fund, which is available to be sold to everybody, including retail, or you can have what is known as a recognized scheme, which means that it is available only for distribution to institutional or retail investors, institutional or accredited investors. It's very easy to get them registered. It's approximately a 2-week process. So it's quite easy to market if you're in Singapore to Singaporean institutions and Singaporean distributors for sale to high net worth individuals. Next slide. The compliance structure in Singapore is similar to Hong Kong. There's a few weird bits that are out there. They have very specific outsourcing guidelines. There is an internal audit requirement. There's some quite detailed IT, cybersecurity and technology risk guidelines that need to be dealt with. And there are just brand new individual accountability guidelines, which are similar to the senior management regime. Next slide. I won't talk to everything about the outsourcing, but suffice to say, if you have an office in Singapore and you do certain activities for that office, provide IT support or HR support or so on, that Singapore office is considered to be outsourcing to you, and so they need to do due diligence on you, which seems a little silly, but unfortunately that is how it works. Next slide, please. I've also listed there some of the cybersecurity practices. Again, I won't go through them in great detail because I think there's some very interesting people who are going to be following up. And likewise, there's some information there on the new objectives that the MAS has set out for individual accountability. There are 5 outcomes, which is broadly to make sure that you identify who are the senior managers, make sure they're fit and proper, and hold them accountable. And then if we move to the types of roles on the core management functions slide, you'll see a number of different titles there. They don't expect you to have all of those people. Next slide, Mitch, thank you. They don't expect you to have all of these people, but they do expect you to have those that are relevant to your organization and for them to be named to the MAS regardless of where they are located. If you go to the next slide, please. And then probably the next interesting bit about this that is different is they've also asked for people in material risk functions to be identified, which clearly in the asset management context is, investment staff who are making decisions, and they need to be identified as well and also held to be fit and proper and held accountable for their actions. The last 2 slides deal with the question of offshore marketing into Singapore. Suffice to say that it is easier than many other Asian countries. Whilst the two main acts are extraterritorial, they're modified by saying that the activity will only be considered to be within Singapore law to the extent that the activities have a substantial and reasonably foreseeable effect in Singapore. And the MAS has specifically stated what it considers to be acceptable very helpfully. It says that it does not apply to marketing to wholesale distributors such as private banks. You may call or meet institutional investors based on a reverse solicitation, and you broadly are free to come to Singapore to meet those types of investors. And if we move to the final slide, as I mentioned previously, there's a mechanism for funds to be recognized in Singapore. It's very popular amongst the alternative universe to have their funds recognized. There's something like 9,000 funds that are recognized for sale to institutional accredited investors. And a number of our clients themselves have been surprised because you don't have to be the manager or the operator of the fund to register it. And so in many cases, the private banks in Singapore have gone ahead and registered a fund and not necessarily told the manager that they're doing it. But there's very few rules around it, and it ticks the box that you're offering with a registered prospectus, which is helpful under the Securities and Futures Act. As I believe I may be dropping out again, I'm going to hand over to our next speaker. Jian, if you could start on China, that would be fantastic.
Sure. Thanks, Philip. It seems like on my side, there's a bit of delay with the screen sharing. So Mitch, I apologize in advance, if I got behind a bit. But the good news is, we only have 2 slides. So speaking of China, as today's subject is 2020 regulatory update, I think for the year 2020 and so far, for China, we have marked, another important year in China's financial market liberalization process. So notwithstanding the COVID-19 outbreak early in the year, there has been no suspension or even no slowdown in China government's efforts, to continue to open up the market. And generally speaking, the key message delivered by the PRC financial regulators is that, market internationalization and opening up will continue to be the general trend or general direction for future developments. And the PRC government has set on a irreversible journey. And interestingly, 2 years ago at Boao Forum, which is a very important conference, high-level conference in China, the top leadership, President Xi, had given a general comment on China's market opening up process, which is sooner than later, faster than slower. So those has been the key tone, in China's securities market and financial market opening up in the past 2 years. And more importantly, earlier this year, the top leadership have emphasized another theme for China's opening up process, which is high quality opening up or high quality liberalization of the market. Because, just think about it. Now China has the world's 2nd largest equities market and also the 2nd largest bond market. But if we look at the foreign investment, the participation level is still very low. It is on both markets, it's below 5%. So, in terms of quantity, China could always easily become the champion. But I think now the government has realized that, for the next stage of China's opening up process, the more important thing is to get higher quality measures, to further liberalize the market and make it more internationalized. And speaking of high quality, I think today we will focus on the reform of China's Qfe or RQfe program. The full name is Qualified Foreign Institutional Investors Scheme, because I think it is a good example of the PRC regulators pursuing high quality opening up measures. So Qfe and RQfe, as some of you may know, has been a long existing program in China, and also one of the most traditional or classic access for the foreign institutional investors to access to China's securities market. And the investment scope generally include A shares, bonds in the interbank bond markets, or bonds traded on the stock exchanges, etc. But over the recent years, after the other access channels such as Stock Connect or Bond Connect become gradually available, actually the foreign investors have had more alternatives or options to access to the China market. So and also because there had been some overlapping with the investment scope. So the Qfe and RQfe regime, which has a longer history, has actually lost some attraction to the foreign investors. But since last year, there has been some continuous efforts from the key PRC regulators of the program, which is CSRC, the Securities Market Regulator, and SAFE, the FX regulator. And this year, CSRC has issued new rule to further reform the RQfe regime, and we think it is more important, than the earlier efforts made by the PRC regulators. The reasons are under the CSRC rules, or as a result of issuance of the new rules, Qfe and RQfe program, which have been two separate programs, for qualified investors to invest in China's financial market, are now merging into one program. So going forward, there will not be two separate programs, and there's just one program subject to the same set of rules. Another feature of the new rule issued by CSRC is the expanded investment scope. So in the past, we already had A shares or bonds, which are also partially or substantially covered by Stock Connect or Bond Connect. But now we're opening up for more asset classes, including commodities futures, including financial futures, including options, and also including some private investment funds in China, as well as margin trading and securities lending. So those have all been welcomed by the market participants. Of course, for some products, there still takes some implementing rules or the final green lights from the regulator to commence trading on the relevant exchanges or markets, but they have all been in principle approved under the new rule. And another important change is that now under the new rules, the eligibility criteria for the so-called qualified investors have been largely relaxed. There has been no hard requirements on, for example, AUM or capital or track record, etc. And there's also no licensing requirements, which means that the applicants no longer need to hold a financial license, or no longer have to have a regulated status in its local jurisdiction. And that's why for this batch of new applicants, we're seeing more diversified types of applicants or foreign investors, including prompt traders and more even small to medium hedge fund managers, and futures companies, etc. And Another key change is the PRC regulators will make the application process simpler, including the submission process and including the timeline that they will need to process all the review and the approval and the final approval. So those are all positive changes. But I guess, you know, for many of my clients who are hedge fund managers, they always have a question, you know, which is why they have to take the Qfe or our Qfe route compared with the other available access channels, you know, including Stock Connect, and also for hedge fund managers, you know, the market access products such as total return swap or P-notes. I think, well, in terms of advantages of the Qfe regime, you know, first of all, it covers a broader scope of asset classes or securities onshore. All the A shares are covered compared with Stock Connect. You know, only a substantial part of the A shares are covered. And also for Qfe, RQfe, so currently there's no quota limitation, but for Stock Connect, you still have a daily quota limit. And for Qfe or RQfe, now you have the designated or exclusive account opened onshore with the custodians or with the, you know, securities depositories, and the applicant or the license holders are also recognized as legal owner or beneficial owner under the PRC law. So I think it provides more comfort in terms of the ownership or the account structure. Well, if we look at the market access products such as total return swap or P-notes, although you have the economic exposure to the A shares, you don't have any ownership or voting rights, you know, from a PRC law perspective. And also from a regulatory perspective, those kind of products issued by some, you know, buy sides are always not so encouraged by the PRC regulator, because they would encourage, you know, the applicants to apply for themselves rather than, you know, behind some market access products, so that the regulators would have more visibility. And another obvious advantage is, of course, you know, for market access products, the purchaser will have to pay additional costs in compared with Qfe or RQfe. So I guess you know, to sum it up, you know, for China's market, in terms of asset management opportunities or in terms of investment opportunities, the regulatory environment will continue to evolve. Well, as you know, as a lawyer in the asset management area, I always joke that, you know, I would never get bored, you know, one way or another. So this is one of the beauty of our practice, is also, you know, the beauty of the China's asset management industry. And for the foreign investors, I guess maybe it's a metaphor would be, you know, it's like entering into a Chinese restaurant, and you're looking at a longer menu now. And you know, you just have more dishes to choose, whether it's Qfe, RQfe, whether it's a Connect regime or another new financial initiative. It can serve more or less, you know, different business objectives. So in the end, you know, how to choose them or how to have a optimal combination of them really depends on your own appetite. So I wish all of you a bon appetit, and that concludes my part.
Jin, thank you very much for a great concise summary of a complicated set of rule changes. Koji, it'd be great to hear what's happening in Japan at the moment as well. Thanks.
All right, hello everybody. Thanks Thanks for participating. I'm Koji Yamamoto, and I'm just gonna. It's really interesting. Usually, I cover topics such as capital raising, and that's usually the main thing that people ask me about. But this year, you know, like everything, 2020 has been quite an interesting year here. What I'm really gonna do in today's discussion, just focus on, I guess, what I call two of the probably bigger regulatory developments that happened in 2020. I'm not going to say that these was all the regulatory developments that happened for that probably relevant for hedge funds or fund managers. We had a lot of other minor development amendments with respect to COVID, but for this purpose of this call, I'm just really going to just focus on two. So the first big one was the amendments to the Foreign Exchange and Trade Act in May 2020. This was a pretty big one in Japan. The entire purpose of this was to permit the greater Japanese government oversight on investments by foreign investors. And it's pretty much, I believe, is familiar to the US laws in effect. It's whereby the Japanese regulators had put a lot of new restrictions and reporting requirements, whereby whether it be hedge fund managers or private equity fund managers, when they take positions in Japanese companies, taking parts in certain types of engaged in certain types of businesses, certain types of filings and approvals had to take place. So this was back in May, and I suspect, you know, this has been done on, this topic is done to death on some level. So I'll talk about it briefly now, and probably, but the second and more interesting topic, because this is a bit more timely, was pretty much what the Japan FSA announced last week was they're proposing some type of amendments to the Financial Instruments Exchange Act, where, you know, to make a long story short, what they're trying to do is be more foreigner friendly. One of the big criticisms of Japan is everything has to be done in Japanese. It's so hard to understand, yada, yada, yada. And so one of the big things that just recently got announced was Japan says, okay, now we're going to let you do things in English. So those will be the two topics that I will be covering today. Next slide, please. All right. All right, there we go. All right, so let's go back to this, the very first one. The entire topic's about the amendments of FET. I suspect many of you have heard about this on some level, and truthfully, I suspect it's not as relevant to many of the hedge fund managers because there's a lot of exemptions, but let's still run through it all the same. The general default rule of these amendments to the Foreign Exchange Act was that foreign investors may be required to submit a prior notification to the Bank of Japan anytime they take 1% or more in a Japanese listed company. This is actually quite significant because previously this 1% threshold was actually set at 10%. Now, the key things to note is that this is not for any type of Japanese listed company. It has to be a Japanese listed company that operates in certain sectors, what we call designated business sectors. So these would be like national security, broadcasting, public transportation. So in other words, the rule is, as a matter of default, if any type of foreign investor, which would probably include all types of hedge funds, private offshore fund managers, takes up 1% or more in a listed company that operates in a designated business, it would have to seek the approval or submit an approval request to the Bank of Japan. Now, while this in itself goes, oh wow, this is so strict, yada yada, this is going to be a lot more tougher. The fact of the matter is, this amendments, what they also did was they added a lot of new exemptions from this entire reporting regime, which I strongly suspect that most of the foreign fund managers could use to get out of this reporting requirements altogether. Next slide, please. All right, so the entire analysis for do I have to make this Bank of BOJ report? Am I caught on this? Truthfully, it's a bit convoluted. So what we've kind of done here is just because let's kind of just narrowed it down into really what I suspect will be applicable to most of the people who are on this call. So there's pretty much 3 requirements, and if you meet all these types of requirements, you don't have to worry about seeking the pre-approval of the Bank of Japan. So I think the first one that which I would like to think is going to be a gimme for everybody, is you cannot be something called a disqualified investor. What is a disqualified investor? Disqualified investors are anybody who has got in trouble with the Japan FSA for violations of this exact same law in the last 5 years, or any type of quasi-government or foreign state entity. These are people that, well, you can't get out of this law. The second thing is, and this is the one that a lot of people get there's some confusion on is another thing that you can't do is you have to be something what we call a passive shareholder. So what is a passive shareholder? Number one, in order to be deemed as a passive shareholder, you cannot seek to become a director or a corporate auditor of the listed company. Number two, you can't make certain types of shareholder proposals. Number three, you can't seek to have any access to any of the non-public information specifically regarding technologies regarding the designated business sector. So, when you talk about these passive requirements, like I suspect for many types of hedge funds, that this should be a problem in trying to meet these requirements. It's one of those things, it's the idea of, listen, you can buy Japanese companies, you can hold as much as you want, but if you're going to start exercising control, if you're going to try to access certain things, well, then we're not going to exclude you from the exemptions. And so the third one of the three is that you have to qualify as what's called a foreign financial institution. What is a foreign financial institution? Pretty much if you're registered in the US as an IA, Hong Kong Type 9, Singapore, I mean, most of those requirements you will be deemed as a foreign financial institution. Just a heads up, the U.S. Exempt Reporting Advisor is not deemed as a foreign financial institution. So pretty much, if you can meet these three requirements, you don't really have to worry about this, the entire rules in general. And this is why, truthfully, a lot of our clients, when they first came out, there's a lot of confusion. What do we have to do? How do we make sure we don't run afoul of these passive shareholder requirements? But generally, most of our clients, after the initial trying to understand the law, most of the clients actually felt better about it. So if you can turn to the next slide, please. All right. So one of the things I do want to kind of, even though I went through that very, very brief summary, if you don't meet all three of those requirements, I don't want you to think, okay, we're done. We're just caught. There are some types of, like I said, the analysis actually does go quite a bit further. They start talking about core business sectors, and it does go quite a bit further. And it's quite possible that you still may be exempt. But it's been our experience that most of our hedge fund clients typically manage to meet those three requirements and really don't have to worry about it. Typically, even though the amendments seem to have lowered the requirements, at the end of the day, with the great expansion to these exemptions, we actually think this was actually a good thing, and for most of our hedge fund clients. But for most clients who have an activist type of strategy, or they want to get involved, do shareholder proposals, yeah, that means you're going to get caught by this, and you're going to have to do this. To start having to make these filings to the Bank of Japan in connection with these types of investments in listed equities. I do want to be quite clear before I jump off this topic is, number one, everything we're talking about is applying for listed equities. There's another very similar regime that also takes place for unlisted equities, which is actually a bit more strict. It's actually where you can not even buy one share without having to go through this entire analysis. But I don't think because of this is for hedge funds. I didn't really want to go much into private equity funds and unlisted securities. And the second thing I do want to note is that there are still post-filing obligations as well, acquisition filings that you have to make. And depending on where you qualify and which exemption that you can use, you may have to do that as well. So if you can turn to the next slide, please. All right. This is the more, I don't know if I'd call it interesting, but it is, yeah, I would say this is quite interesting. So pretty much what happened last Friday was, just a couple Fridays ago, was the Japan FSA, they proposed all these revisions, and it's all come to this thing where, well, one of the big things about that was to permit the application or submission of English documents for the entire regulation process. And it's really kind of interesting. I'm not too sure for many of you who are in Japan or were thinking of coming to Japan, just to give you a bit of backdrop to this entire initiative. Historically, probably even from 4 or 5 years ago, it all started with the Tokyo governor of Japan. It's really this kind of concept of, let's kind of try to make Tokyo or Japan a financial center again. And there's this kind of been this real big push to try to, I think they were getting tired of the brain drain Let's be honest, most, even if you do Japan equities, a lot of the top fund managers who are trading Japan, they would, it's better. Just they go to Singapore, they go to Hong Kong, they go to much tax-friendlier jurisdictions. And so Japan, I guess, was getting quite frustrated with that. They want to bring the talent back home, and it's one of those things that they were been always historically struggling for the last couple of years. And now, just recently with the new prime minister, in fact, this has actually kind of been really boosted up in terms of priorities. They're going, okay, well, we really got to see what we can do to bring back fund managers to Japan. So as part of that entire process, and truthfully, we'll see how much effect it has, is they go, all right, apparently one of the complaints that they said that they were getting all the time was the registration process in Japan. It was just too difficult to navigate, it's too hard to understand, especially because everything had to be done in English. And so this new proposal, which it's going to kick in from next month, it's not next month, I'm sorry, from next year, is really with the entire idea of saying, hey, let's trying to make this registration process in Japan a lot more easy. Let's try to make compare it to the registrations in Hong Kong or Singapore, or even the US. And because the fact of the matter is, I'm not sure if anybody has any experience with doing registration here in Japan. It's pretty frustrating. It could be. I have to be very careful what I say, but the fact of the matter is there's a certain level of subjectivity in the applications, which makes it very, very difficult in the sense that you could have a perfect application and you could submit it for one company, and you can have that exact same application and you submit it maybe 6 months later, and then it'll be totally marked up, and it just be it's one of those things that it's very frustrating for a lot of people, because it's very difficult for us to say what is the right way to complete these documents. It's because it changes so much based on who's reviewing your application. So I know, I've heard the same stories too. A lot of people would start talking about the registration in Japan. It could take 1 or 2 years, or there's a lot of horror stories about Japan in terms of the registration process. Some of it true, some of it not too true. Some of it it's just really hard to say. But I'm just thought maybe before we start talking too much more about the registration and this English documentation, let's just touch base for just a couple of minutes and just how the Japanese application process goes. As pretty much it's really much divided into 2 stages. The way it would work in Japan is you make your notice to that you'd want to get registered, you meet the FSA, and then you prepare all these documents. It's maybe about 15 to 20 documents based on the registration that you're applying. You would make the submission, you'd complete it as much as possible. You get then the KFB would review it, you get these comments back, then based on those comments you review it, you revise it, and then you resubmit. And it's this kind of back and forth process that could easily go, based on how responsive you are or how the KFA regulator is. It could take a long time. But once you've done this pre-submission stage, like as you keep going, hopefully the comments that you get are less and less and less. And there's going to be a certain time where the Japanese regulator goes, okay, these are good, and you can hit the submission stage. The submission stage, actually, ironically, it's actually the easiest. You're pretty much done. Once you submit your documents for formal submission, you will get whatever license you were seeking in 2 months. That's set forth in law. So it's this kind of process, and it's really that first stage that I think that really loses a lot of people. Sometimes you'll get comments that, like literally font size. Maybe they don't like where you put your punctuation. So it's this kind of process that, we would always advise our clients, it's not worth having a debate on the regulator on what's needed. Just if they ask you to jump, just jump. It's just a lot less easier, it's less painful, and it's not a debate that you're going to ever win. The regulators have absolute authority on this. So but I think that's the kind of thing that's kind of, trust me, I've heard all the gossip, I've heard all the stories about how it could be bad. But I think it's something that they're looking at and they're trying to do better. Next slide, please. So just to give you some more insight on this entire color of this entire new regime about English language documents, it could pretty much be applied to all of the 4 licenses in Japan, the type 1. No, I'm sorry, I shouldn't have said that, not the type 1. It could be used to the type 2 on a limited basis. It could be used for the discretionary investment management license, and it can be used for the IA license. It's one of the things that you should also know. It could also apply for upgrading. So if you have an IA license and you want to go up to DIM, you can use that as well. And not only that, it's just not for registrations. You can also do this for a lot of the reporting requirements. So, which was quite unheard of before. So this entire kind of thing is to notice is this is the Japanese government's efforts to try to make Japan a lot more kind of friendlier place for foreigners coming in. They're really trying quite hard to bring back the asset managers who have that operations in Hong Kong or Singapore or the US or wherever it may be. But a couple of things that, I'm not trying to be cynical, or I guess I'm just trying to be more objective on this. This isn't the first time that the Japan FSA has done this. Back in 2018, the Japanese regulators, they created a license for high-speed trading. Before it was unlicensed activity, you didn't need a license, but back 2 years ago, they made it where you actually had to register at the HFT, and same thing. They said the same thing. All right, we want to make this available in English. And truth be told, we handled quite a few of the registrations. I don't know if that was, yes, maybe we could do the submission in English, but it was definitely not something that they encouraged. And so it was just one of those things where you would actually meet the Japanese regulators who would be handling your application. And it was quite clear that these people did not speak English. They did not read English. So it's one of those things. They would pretty much be beseeching you that, or they pretty much even told you that, listen, if you did your application in English, sure, they'd have to accept it. They'd have to review it, but it's going to be slower and it's going to be tougher. So truthfully, I know that HFT registrations, the option was always there to do it in English, but I really don't know how many people actually used it at the end of the day, because especially for those people who are under a tight deadline or had something, I think it just wasn't something that, we ended up doing a lot of them to being bilingual, and any of the comments that you got back were in Japanese anyways. So one of the things that I do want to kind of point out, and I don't want to drag this out, is listen, I think this is great. I am a lot more optimistic this time, because this time you have to understand the Japan FSA, the people who make these kind of announcements on, oh, let's do things in English, let's make Japan great again or something like that. I get it. I think that's great. I think that's good that they're trying to do something like that. But that's the Japan FSA. The Japan FSA is not the people who are looking at your registration application. That's a different body called the KFB. It's a totally different administrative body, and I don't think they have those same kind of priorities in mind. So it's great. I've met the Japan FSA numerous times. So that we're reasonable, we're fair. We want to do this better. We want to make Japan easier, get a better rep. They say that, and I'm sure they believe it. But at the end of the day, when you make your submission for your application, you're not dealing with the FSA. Like, not unless you're legal in general, or you went, so oh, sorry, too long.
Koji, just say, I might have to let you hand over to Lisa, unless
Sure.
you've got some other slides you need to get.
All right, I do apologize. So I will cut it off there. I do apologize, Lisa. I will let you jump in. I do apologize, everyone.
Not a problem. Lisa, what's happening in Australia?
Oh, hi. Apart from the fact it's now 2:15, or getting on to 2:15 a.m. in the morning, it's there's not a lot happening here right now. But I tell you what, there's been a lot that's happened over this year, and slightly different approach to the other speakers. I thought I'd just try and canter through a few of the developments in Australia that have been really quite interesting in the funds and financial services sector. I'll touch firstly on licensing for foreign financial services providers and the relief that is now now set in stone for foreign fund managers, because I expect that's of interest to people that are on the call. Traditionally, Australia has operated a fairly generous exemption regime for foreign financial services providers who've been regulated in a handful of recognised jurisdictions, those being the US, the UK, Germany, Hong Kong and Singapore. That the relief that was made available to them essentially was an exemption from having to hold an Australian financial services licence. It depended on the provider notifying ASIC of reliance on the licence and lodging various documents to take advantage of the relief. But once you'd notified, there was literally no conditions that attached to that relief, and the foreign financial services provider could actually set up a business, like an operation on the ground in Australia. Probably now about 2 years ago, ASIC indicated that it was going to repeal that relief. The relief is no longer available, so people can't apply for it. The last date at which that particular relief could be obtained was 31 March this year. And we're now in this transition period where there's a new light foreign financial services licence that can now be obtained. So the applications for that opened on the 1st of April this year. And it's not too bad. It's certainly a lighter regime than a full Australian financial services licence. Again, it would enable the conduct of business both offshore and also in Australia. Covers a broader range of jurisdictions than the previous exemption regime. So there's probably about 10 or 11 jurisdictions now that are covered, where if you were regulated in one of those jurisdictions, you could proceed down the limited licence route. And there's a range of the normal Australian financial services licensing obligations that don't actually apply to somebody that holds that light licence. The other option for people who are either wanting to market their services to carry on funds management activities for Australian clients, or alternatively want to sell them foreign funds, is to rely on the foreign funds manager relief. That relief doesn't actually commence, unfortunately, until March 2022. So despite entreaties to the regulator when they were creating this particular relief, where we pointed out that there was a big gap between 31 March 2020 and March 2022, when no one would be able to rely on the new relief and couldn't apply for the old relief. That they haven't done anything about that particular problem. But the new relief is quite generous. It applies essentially to foreign fund managers who are regulated in any country that's a signatory to IOSCO, which last time I checked covered pretty much every jurisdiction that I could possibly think of. It's again a very light regime. If you essentially notify ASIC that you intend to rely on the regime, then there is very few conditions that attach. There's some notification requirements essentially around changes to your regulation in your home jurisdiction, or to enforcement action that may be taken in your home jurisdiction. But otherwise, there's really not a lot of conditions that apply to that relief. One of the big differences, though, between that relief instrument and the previous position is that you can't carry on a financial services business in Australia relying on the relief. Still very, very useful though. So that's probably the main one that I wanted to touch on, because it will be relevant to people that do want to market their services to Australian superannuation funds or to other Australian clients. There's various other things that have been going on this year, including updates to our fees and cost disclosure regime. some of the people attending the call may work for managers or fund operators who have Australian superannuation fund clients. Those clients are required to collect fees and costs information from their the funds that they invest in and from the fund managers that they invest with. There's been changes to some fairly minor changes, but some changes made to that regime in September, which we'll see flow through to the nature of the information that's sought by those clients. We have design and distribution obligation regime commencing next year. It's actually been deferred as a result of COVID and now doesn't commence until October 2021. And it's a very similar regime to the product governance regime that exists in the UK, you know, with a requirement to create a target market determination and to take reasonable steps to only have products issued to people that fall within that target market determination. And there being some requirements to keep an eye on what distributors are doing. We're in a bit of a hiatus at the moment because we're waiting on some further guidance. ASIC has now exercised its product intervention powers under the regime that commenced last year. Its latest target has been CFDs. And in fact, today, the acting head of ASIC has given a speech saying that they're still very concerned about CFD marketing in Australia, notwithstanding the fact that they have actually made some changes, in particular to the leverage that can be implemented on retail CFD contracts. We've had lots of sort of COVID-related developments this year, including a current proposal to extend virtual member meeting legislation, which was implemented to enable meetings to occur without physical attendance through COVID. We've had an early release of superannuation scheme, which has resulted in some outflows from the superannuation system. Essentially, a limited amount has been available to be withdrawn by superannuation members this year. We've also just seen the beginnings of an ASIC governance review of the operation of retail registered managed investment schemes in Australia. That's just at its inception, and it seems to be targeted at getting information from about 10 operators, so it's not across the whole industry, but almost certainly it's a precursor to ASIC revisiting parts of the regulatory regime for those schemes, including whether or not they should be required to have independent directors on their board, or whether or not there needs to be some changes to the existing compliance regimes that rely on the existence of a compliance committee. We've had a focus by ASIC on funds that have had the word cash in them, particularly because it turns out a lot of cases that funds don't actually invest in cash. They might invest in other assets, like, for example, debt instruments. ASIC has actually been on a campaign this year, which has resulted in a number of those fund operators changing the names of those funds, and there's actually been some freedom of information requests made by journalists to try and get hold of the names of the organisations which have been affected. So that's been quite interesting. AUSTRAC is becoming more and more active. For a long period of time, it was a fairly passive regulator. The headline for this year was that they have settled the case they brought against Westpac, $1.3 billion, which involved substantial non-reporting of international fund transfer instructions in circumstances where the transactions were considered to be high risk. I'll actually pause there. I think I've used up my allocated time, and I do want to leave some time for questions as well.
Lisa, thank you very much. Yeah, it's a lot of regulation and legislation to cover in a short period of time. And thanks for your patience. I do know it's late in Sydney, Melbourne, sorry. There's a couple of questions that have come in. Alex, I might send the first one to you if I may. Someone has asked, is there going to be a change in the sanctions regime if we're talking about a change, or as we're talking about a change in presidency in the US? And have we actually seen much impact so far in the sort of PE alternative fund manager universe in the sanctions? I don't think so. I think it's mostly banking, but it'd be good to hear your opinion.
Very, very complex question. I think the short answer is that I think we're in for a period of heightened disputes between both very large countries, and unfortunately, I think if there's not much that Washington agrees on these days, but certainly a robust approach to the mainland or the People's Republic of China is probably one of the few things which does enjoy cross-aisle support. So ever since Richard Nixon first visited China in 1972, the relationship has gone up and down, and I think we'll see more of that in the Biden administration, and hopefully after some time both superpowers will reach some sort of détente. In terms of the practical effect, we're yet to see some of the effects of the existing US sanctions work their way through the system, and we're yet to see the effects of the new Chinese regimes too, the unreliable entity regime. So a lot to watch this space on. Banking institutions will be most immediately affected, and but there will be an impact on asset managers. So just last Friday night, the US announced sanctions in relation to an inability to invest, I think, in 31 mainland firms. That comes into effect in January, and that will impact all sorts of things from indexes to direct investment and so on. So there's a lot going on, and unfortunately, anyone in the region just has to sit back and watch the fireworks.
Sorry if I'll mute myself. There's one other question as well about whether COVID-19 has had an impact on foreign investors' interest in investing in China. Obviously, COVID-19 slowed things down. I think when you look at the stats of the number of the sort of pent-up Qfe sort of interest, and I think Jen, I'm sure you're seeing some of that, and I know there's quite a bit of interest in the fact that the QDII program's just been revamped again, or sort of refunded again. Do you think there's been much slowdown, Jen, in sort of the way that we've seen interest in China?
Yeah, I mean, yeah, it's an interesting question. I guess based on our observations, the COVID-19 has actually accelerated, the process of some opening up measures or efforts in China's financial industry, and that's also grounded because according to the PRC, the financial regulators, including the central bank, the CSRC, and also the banking industry regulator, CBIRC. I think they have made some public comments at different occasions this year that, regardless of the COVID-19 situations, the PRC regulators would like to enhance, the confidence of the foreign investors community for their long-term commitment into the China market. And also based on what they have taken, the measures that they have taken so far this year, I think that is consistent with the, with the verbal comments made by the PRC regulators. And also, for example, say the wholly foreign-owned mutual fund managers, which is a novel development in China. and CSRC have started accepting applications from some applicants, since April 1st this year, and already there have been some first movers have got the approvals, including BlackRock, JP Morgan, etc. Yeah, and actually another point I would like to emphasize is that although there's the so-called U.S.-China tension or some talks about U.S.-China decoupling, at least on the China side, there has been no discrimination at all towards U.S. institutions or U.S. managers, U.S. investors. Actually, many of U.S. investors have already become the first movers, or among the earliest market participants which have benefited from China's opening up measures.
Thank you. Lisa, I've got a question for you, and there is also how many people are you seeing starting to make plans to onshore themselves into Australia?
That's a really good question, because for a period of time there, it felt like there was a lot. And I would say it has probably slowed a little bit. And again, I think that's probably a product of COVID. So I think what we might see is that once Australia starts to lift its international border restrictions, which is still in place at the moment, that perhaps that interest in coming out to Australia might increase. One thing I would say though is there really has been no moves by Australia to make the tax regime here for fund managers any more attractive. It was really interesting hearing what's being done in Singapore to make it more attractive for fund managers to operate out of Singapore. And there really hasn't been that sort of work done in Australia. So I think that will always weigh on people's mind as to whether they're going to do business.
Yeah,
it's a great place to live, but it's expensive.
Yeah, well, right, especially as more super funds come offshore themselves. And Koji, we've got the final question for you. We've got a couple of people who are worried about the new approvals that are required under the foreign investment rules, because obviously for activists or some of the more PE type firms, they often take a seat on as a director of a quoted or a listed company, and where does that leave foreign firms?
So I guess really you're going to have to make that kind of distinction between private equity and listed listed companies. But the fact of the matter is, if you are going to participate in, or you want to seek to become board of directors, you can do that. There's no reason why you can't do that. But the fact is, you will no longer be treated as exempt. In other words, you're going to have to go through the entire approval process. And there are various stories on this. As a general matter, I wish I can say it's always going to be fine. They're going to approve everyone. But I understand that it's getting more strict now, where they ask you more questions, they ask you more about your shareholders. So it's one of those things. I do apologize if I wasn't clear. It's not that you can't, if you can't be a director, or you can't make certain types of shareholder resolutions, or you can't, access certain technology. But if you're trying to be exempt from this entire reporting regime, then you have to follow and become a passive shareholder. If that's something that you go, no, we want to get involved, we want to participate, okay, that's fine, but you will need to seek their approval for every time you get the 1% and every time you take certain types of vaccines.
Got it. Right. Mitch, I think that brings us to the end. I might hand it over to you, and thanks Lisa, Koji and Alex for participating, particularly Lisa when it's so late in Oz.
Thank you so much, Lisa, Koji, Jin, Alex, and of course, Philippa and ComplianceAsia. Thank you so much for making this HFA event possible. To all of our attendees, we will be sharing a recording of the event as well as the slides, which I know we weren't able to go through every detail, but it was quite a comprehensive presentation. And I want to again thank our sponsor, ComplianceAsia, and thank all of you for attending. Have a great day or night. Take care. Bye-bye.
Thank you very much, everyone.
Bye.
Thanks all.
Bye.